This video will discuss the new Global Intangible Low-Taxed Income, or GILTI, rules of Section 951 Cap A. These rules do not apply until 2018 for calendar year taxpayers. GILTI is essentially a new type of Subpart F income where the income is deemed distributed from a controlled foreign corporation, or CFC, to its U.S. shareholders. Under the GILTI rules, nearly all of each CFC's income will typically be deemed distributed each year. In this video, we will only discuss GILTI as it applies to U.S. individual shareholders. There are some additional GILTI rules that apply to C Corporation U.S. shareholders. As with other types of Subpart F income, GILTI will likely not be treated as qualified dividend income. GILTI equals net CFC tested income minus net deemed intangible income return, or DETR for short. Net CFC tested income equals the U.S. shareholders' aggregate pro rata share of tested income of each CFC, less the U.S. shareholders' aggregate pro rata share of tested loss of each CFC. If the U.S. shareholder only owns one CFC, then net CFC tested income will simply be the tested income or loss of that CFC. The tested income of a CFC starts with the CFC's total gross income less certain amounts, such as gross income associated with U.S. effectively connected income, Subpart F income as computed under the pre-existing Subpart F income rules, income that would be Subpart F income but that was high taxed, dividends received from related persons, and foreign oil and gas extraction income. The gross income remaining is then reduced by deductions that are allocable to the tested gross income. In many cases, all of the CFC's income will be tested income. Net DETR equals 10% of QBI minus certain interest expense incurred by the CFC. QBI is qualified business asset investment and means the quarterly average of the adjusted tax basis of the CFC's depreciable tangible property used in the production of tested income. In many cases, all of the CFC's depreciable assets will be included in QBI. You must calculate the tax basis of the CFC's assets using the alternative depreciation system in Section 168G, which requires depreciation on a straight line basis over the class life of the asset. The interest expense will include all interest paid to unrelated parties. Now let's go through an example. Individual A owns 100% of FC, a foreign corporation in country B. FC is the only foreign corporation that individual A owns. FC is a controlled foreign corporation. FC has no U.S. effectively connected income, no Subpart F income, no income that would be Subpart F income but was high taxed, no dividends from related persons, and no oil and gas income. FC has after-tax profit of $100. Included in the $100 is an interest expense deduction for interest that FC paid to unrelated parties of $3. The average tax basis of FC's depreciable tangible property was $80. FC's tested income would be the full $100. Since there is only one CFC, the net CFC tested income will be $100. The net DETR will be $5, computed as 10% of the QBI minus the $3 of interest expense. Thus, GILTI will be $95. Individual A will need to include $95 on his Form 1040 as GILTI for the year. The GILTI will likely be taxed at ordinary income rates. Individual A may want to make an election under Section 962 to be taxed at corporate rates. Alternatively, individual A may want to consider forming a U.S. C corporation and transferring the shares of FC into the U.S. C corporation.